Hi everyone, welcome to the macro market update for the second quarter of 2021. I am your portfolio manager Rajiv Dixit. We have lots of useful content for you in this video, so let's start by laying out an agenda for this update. As always, we will start out with a quick recap of the high points from our previous market update. Then, we will get into a brief discussion of the key events and news that happened in the last quarter. This is where we will give you our viewpoint of this event and discuss how, if at all, it will or can affect the portfolio. After that, we will get into the charts, look at the long-term trends of the financial market to form our outlook for the next quarter and beyond. Sounds like a plan? Let's get started. In our last update, we had highlighted a few important takeaways for you. Let's quickly recap them so we are all on the same page. We had shown you that in September-October period of 2020, we had noticed that the small cap index, Russell 2000, started to break out of its 2-year sideways pattern. We talked about how we believe that a change in the direction of the small cap index indicates a change in the direction of the economy, and an economic change is much more important to us as long-term investors because it lasts much longer. We had shown you the last time a similar breakout that happened in November of 2016 and how that breakout led to an upward trend in all equity markets in the next 2 years. We had pointed out that there is no way to know if this is going to have a similar outcome this time, but it is important to be prepared for such an outcome. In preparation of that outcome, we told you that we started to raise our equity positions in October of 2020 and will continue to do so wherever warranted in 21 if this trend continues. $2.8 trillion or 14% of the total US GDP. Yes, that is the amount of stimulus the federal government has injected into the economy in the past 4 months, plus $2.2 trillion that came in 2020 via the CARES Act. That brings the total to $5 trillion. Just to put the number in perspective, after the Great Recession of 2008, the federal government infused $840 billion via the Recovery Act in the economy. Or how about the Great Depression in 1933? The government infused $856 billion after adjusting for inflation via the New Deal. Thus, we have added more than 5 times the stimulus into this economy than what we did in the Great Recession or the Great Depression. Think about that for a minute. 5 times more. Now, some people agree with this historic move, some do not. But everyone agrees with the fact that this will have an immediate positive impact on the growth of our economy like we have never seen before. Could this be the reason we are seeing what we are seeing in the charts? Another interesting fact about the federal stimulus. We have spent $5 trillion into the economy in the past 12 months. The total tax collection for the year 2020 for the entire federal government, $3.42 trillion. But who's counting? If the federal stimulus was not enough of a catalyst for this economy, how about the American Jobs Plan that was announced at the end of March? If this bill is passed as proposed, and yes, I know that's a big if, but if it were to be passed as is, that would inject another $2.25 trillion in spending on infrastructure projects all around the country. I ask again, could this be the reason why we are seeing what we are seeing in the charts? I think we all know that the current problem cannot be solved by only throwing in trillions of dollars of fiscal stimulus into the economy. What we need is a medical victory over this virus. In Q1, the financial markets were positively surprised by the pace at which the vaccine rollout around the world. By the end of Q1, 590 million doses had been administered worldwide. And according to Bloomberg, 150 million of those have been in the United States. What is important to the financial markets is that even though the global cases are starting to rise again, the average rate of inoculation is vastly outpacing the rise in new cases. One of the big news stories of Q1 was the rise of interest rates, or what we call the bond yield. The yield on a 10-year US Treasury went up 83 basis points or 0.83% in the first quarter of 2021. That is the largest increase in interest rates since Q4 of 2016. Why is this important to know? Well, you need to know that when yields or interest rates go up, it means that bond prices are going down. So from our portfolio point of view, that part of the portfolio is going down. The good news is that we generally reduced our exposure in bonds in Q4 of 2020, wherever it was warranted. So even though we are hurting because of this move down in the bond market, we're not hurting as much as we could be. Overall, the rates are still relatively low, with the 10-year US Treasury yielding about 1.7%. But the market is getting spooked by the rate with which it has changed, and not so much where the interest rates currently sit. Federal Reserve Jerome Powell sees this sharp rise in interest as an orderly process, a sign of economic confidence. We cannot disagree with that viewpoint. In the short term, the rise of rates has proven to be a headwind for the growth stocks and stocks in general, but we believe that this would be a net positive for stocks in the long term. Legendary investor and billionaire hedge fund manager Ray Dalio, in his recent book Principles, says, and I quote, "Everything looks bigger up close," by which he means what is happening today seems like a much bigger deal than it appears in retrospect. I think those are incredibly wise words for a long-term investor to remember. Thus, I have added this new section called The Noise. This is a section of the update where we will include everything that seemed important to the market at the time it was happening, but should be looked at as noise by a long-term investor. The quarter opened up with some highly unusual activity in many individual stocks. The one that caught the most attention of the media and market participants was the GameStop stock. While this does not directly impact our portfolios, I feel it does raise an important question for all of us to answer and to ask ourselves. The question is, are we investing or are we gambling? As long-term investors, it is most important to keep this distinction clear in our minds. In January, I wrote an article to detail my views on this debacle and how we can learn to answer this especially important question. All said and done, from a portfolio point of view, GameStop debacle can be easily put in the noise section. Now, I want to tell you about an investment idea. This investment has gone up 95% since the start of the year, and about 750% in the past 12 months. I will also tell you that there is no way to rationally calculate the true value of this investment. And oh, by the way, there's also a very good possibility that governments around the world might make it illegal to own or at the very least hard to transact. But look at the return. Wouldn't you want to be in that, right? Of course, the answer is no. Why? Because we are long-term investors who are investing, not gambling. We care about making money for our future, but we also care more about not losing it. Yes, I am talking about Bitcoin. I know this is a controversial topic, but I have been asked about this enough times for me to include my opinion in this noise section. Till we have better clarity and confirmation on how this supposedly new world currency will work and how we can reasonably determine the value of this investment, I will continue to put this in the noise section. A quarter with so much noise, so much news flow, it is easy to get distracted, to get influenced into the near term. At such time, what matters most is knowing who you are. I think Aristotle said it best. Knowing yourself is the beginning of all wisdoms. So let's find that wisdom as a long-term investor in the following charts. Since our current outlook is based on what was happening in the long-term chart of the small cap index, it would make sense to look at that chart to see if the outlook is still valid going forward. This is the monthly chart of the Russell 2000 index. As you can see, this is where the index broke out in last October, and since then it has been in a clear uptrend. I'm happy to report that nothing has significantly changed in this chart to change our view here. Let us look at the same index on a weekly time frame. In our last update, we had pointed to you that one of the reasons that makes us so bullish about this outlook is the fact that the small cap index is starting to outperform the large cap index. Let us take a look at how that is going. As you can see here in this chart, the small caps, that is the colorful line, is not only outperforming the large caps, which is the blue line, but actually that outperformance is increasing since we last spoke. Another good sign for the economy. Now lastly, let's look at a few things that have not been doing so good in the past quarter. The first thing that comes to mind is the tech sector. The tech stocks, or the Nasdaq, was the outperformer last year, but this quarter it has been lagging severely to the other sectors of the equity market. We also generally have a good amount of exposure to tech, which makes keeping an eye on it more important. So let's look at the chart and see if it is broken. As you can see, this index has pulled back a bit lately, but notice this horizontal green line that I have drawn here. It's called the support line. The index keeps bouncing off this support. That is a good sign. If it keeps doing that, we are safe holding these investments. Now notice another thing on this chart. That same line was previously a resistance line. That means that the index used to go up to it and fail. Funny how these charts work. Resistance becomes support, support becomes resistance. If you're interested in this, let's talk more about this in our next review. Lastly, let's look at the bond market. As I had mentioned before, the bond yields have been going up, which means that the bond prices are going down. We still have some exposure to bonds based on your risk profile. So let's look at this as well. This is the monthly chart of the US 20-year Treasury bond index. It is a longer term chart, but as you can see, something remarkably similar is happening here as well. The bond prices have pulled back significantly, but are sitting right at the support line. It is also important to note that the prices have come back to the pre-pandemic level, not any lower, not any higher. While no one likes investments to come down in value, in this case, it only shows money is moving out of safety trades and moving into the equity market around the world. In summary, I would say that the assumptions and the projections we had made in the last quarter about the long-term trend of the equity market being up still hold true as of now. Some parts of the equity market have weakened in the past quarter, but at this time, that weakness looks more like a pause than a change in direction. The weakness in the bond market as well looks to be more of a healthy correction, which is warranted considering the current environment of upward moving equities and the impending end of the pandemic panic. I want to remind you again, the purpose of this update is not to predict the future. No one can do that. The purpose of this update is to inform you of what we're seeing and how we're preparing for it. Of course, if things were to change between now and the next update in 3 months, we would be reporting about those changes and how we adapted to them in the next update or in our next conversation. We cannot close this piece without highlighting one obvious fact. The above views of the market, the narration of the events, is a general view. You know that every portfolio in Parks Capital is managed based on who you are, and thus they all look a bit different based on your risk tolerance, your individual goals. Please keep that in mind. We look forward to talking to all of you in your quarterly portfolio review meetings. Again, thank you for giving us this opportunity to be a part of your financial journey and for the trust that you show in us by letting us manage your portfolio. We find ourselves extremely lucky to be surrounded by all of you as our clients. Thank you.